Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to the important events on the horizon. Let's start with what moved markets this past week. We saw some truly unusual market dynamics with bond and currency markets sending signals we haven't seen in decades. The big story was a rare divergence between Treasury bonds and the US dollar. For only the third time in 50 years, we saw bond prices rise while the dollar weakened against other currencies. This unusual combination suggests major investors are positioning for Federal Reserve rate cuts before year end, with some expecting reductions up to 0.75%. When these two markets move in opposite directions, it often signals a turning point in Fed policy. For diversified portfolios, this creates interesting opportunities. Bond holdings may benefit from falling rates, while international investments could gain from a weaker dollar. What's particularly notable is how calm the bond market remained despite ongoing tariff announcements. The 10-year Treasury yield held steady around 4.25%, a stark contrast to earlier this year when every trade headline caused wild swings. This stability suggests investors are looking past short-term disruptions and expecting the Fed to support the economy if needed. For fixed income investors, this creates an attractive setup. If the economy stays strong, yields likely won't rise much further. But if growth slows, bond prices could rise significantly. It reinforces why we maintain meaningful bond allocations even during uncertain times. We're also seeing unusual disagreement among economic forecasters. The Atlanta Fed projects strong 2.53% growth for the third quarter, while Wall Street economists expect just 0.9%. This isn't typical variance. It represents fundamental disagreements about consumer strength and business inventories. Either the Fed's models are detecting strength not yet visible in sentiment, or they're missing early weakness signs. This level of uncertainty reinforces why we avoid dramatic shifts based on any single prediction. Instead, we maintain diversified positions that can perform well across different scenarios. Now, let's look at what drove our performance over the past week and why we remain confident in our positioning. Apple led our holdings with a 6.1% gain after announcing a $100 billion investment in US manufacturing. This isn't just about politics, it's smart business strategy. By bringing production home, Apple reduces supply chain risks and may receive exemptions from certain semiconductor tariffs. For a company of Apple's size, this strategic flexibility is crucial. The investment reinforces Apple's commitment to innovation and quality, ensuring they can maintain the premium products customers expect. This position demonstrates our focus on owning companies that can adapt to changing conditions while still maintaining competitive advantages. The information technology sector was our strongest performer, driven by multiple positive developments. Our tech holdings benefited from continued AI infrastructure investment, new government incentives for domestic chip production, and favorable positioning as trade policies evolve. Companies like Apple, Nvidia, and Broadcom all contributed meaningful gains. What makes technology compelling is the convergence of long-term trends. Businesses need AI capabilities to compete. Government wants secure supply chains, and consumers demand innovative products. While valuations have risen, strong earnings growth and strategic importance justify our conviction in market leaders. Our size strategy also delivered exceptional results, with mega-cap holdings significantly outperforming smaller companies. This wasn't just about size, it reflected the market recognizing that larger companies have distinct advantages in today's environment. Companies like Apple, Tesla, Nvidia, and Walmart all posted strong gains. These industry leaders benefit from better access to capital for AI investments, stronger negotiating positions on policy matters, and financial strength to navigate uncertainty. While some worry about concentration in large companies, we see their dominance as justified by fundamental advantages. In periods of change, the biggest companies often have the resources not just to survive, but to thrive. Looking ahead, here are the key events we're monitoring that could shape the markets in the coming week. Tuesday, 8:30 in the morning Eastern, brings July's inflation report, giving us the first complete picture of how consumer prices are responding to recent tariffs. June showed prices rising 0.3% monthly and 2.7% annually. Markets will watch closely to see if tariffs are pushing everyday goods higher. This data has become even more important as major banks now expect Fed rate cuts as soon as September. Any cooling in inflation could reinforce those expectations, potentially benefiting both stocks and bonds. Thursday morning brings retail sales data for July, a crucial indicator of consumer spending strength. June showed a solid 0.6% increase, bouncing back from May's decline. Since consumer spending drives 2/3 of our economy, this report provides valuable insight into whether Americans are maintaining spending despite higher prices. Strong sales would suggest economic resilience, while weakness might indicate growing caution. We're also watching earnings from major technology and retail companies throughout this week. Recent results have been encouraging. Palantir just reported its first billion-dollar revenue quarter with 48% growth, showcasing AI investment power. Analysts expect S&P 500 companies to report 10% earnings growth versus last year, marking a third straight quarter of double-digit gains. These reports help us see beyond headlines to understand how companies are navigating challenges while investing for the future. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thanks for joining us, and we'll see you all next week.